So good evening, everyone. Thank you for attending my talk. My name is Josh Jimenez. I'm an internal medicine physician, as Dr. Cochin said. We are located here in upstate New York. I currently work for Family Care Medical Group, and Dr. Cochin and I completed our residencies at SUNY Upstate. So the goal of this presentation is to guide you through personal finance as it pertains to our profession. So I'm hoping that this is helpful for you. I know the first talk I gave has been shared before, and I'm always happy to answer questions about this. As Dr. Copen said, I've had a longstanding interest in this since really medical school, but definitely throughout my residency. So starting off with disclosures, first off, I'm not a financial advisor. Actually, Dr. Coach and I share a financial advisor, an actual one. But I like to give my advice to people in our own field. But the content of this presentation is really just for educational purposes. I have no financial disclosure or conflicts of interest with the material in this presentation, unfortunately. So just to start with an outline, I will start by teaching you how to build a foundation for good money habits by way of budgeting and debt management. Then I will discuss the importance of protecting your biggest asset with the right insurance, and I don't mean car insurance. And finally, I will talk about saving for retirement, reaching financial independence, and even a basic investing strategy if you stay through to the end. So let's begin with budgeting. So occasionally through this presentation, you're going to see some of these pie charts and things. I originally gave this talk as my capstone presentation with one of my friends and colleagues when we were PGY3s. So we sent a poll out to our program, which included, it was mostly residents, but a couple attendings I know answered in here as well. But we sent a poll out to our program, received responses for a lot of personal finance related questions. In this talk, I will show and discuss some of these results to make my points. And so one of the first questions asked if people had defined budgets, and 61% of people said no. So that's why I start here. Every road to financial independence starts with a good budget. So why do you need one? We receive our paychecks usually on a bi-weekly basis, which is our amount after taxes and benefits have been accounted for. This amount then gets split between living expenses, entertainment, savings. And so without a defined budget, we wouldn't know how much is an appropriate amount to be putting into each of these categories based on our salaries. If that's the case, often one of these categories shrinks, and you can guess that it's probably the savings. There are some budget rules out there, and this is usually the one that I refer to. It's called the 50-30-20 rule. And what this means is that 50% of your take-home salary should go towards paying for needs, 30% should be for wants, and 20% should go to savings and debt repayment. So if you're a resident and haven't already started to look at your budget, you'll find that it may be very difficult to stick to this. I know when I was a resident, I've actually had to flex the rule to 65% of my budget was going towards needs, 20% to wants, and then I was only saving about 15%, which, as a resident is still fairly good. Since, at the time, all my living expenses were already at 65% of my take-home salary. The important part is to have a rule that includes all three categories, though, and it's also important to make sure you stick to it. So the needs section includes housing and utilities, food and groceries, insurance, which we'll talk about, healthcare, car, cell phone, and minimum debt repayment. You'll notice that minimum debt repayment is in this section, as we can't really avoid paying the minimum payments on our loans. I don't want you all to default. So in the savings and debt repayment, we have retirement savings in the form of 401k and 403b contributions, which we'll talk about, IRA contributions. I have a large section on that as well. Extra debt repayment and building an emergency fund are also very important parts of this section. And again, we'll explore why. The wants section includes everything else. So whether you like to travel, dine out, spend on entertainment, clothing, all of that falls under this section. And for any of you who know me, this is where my funds for my golf clubs and my speakers come from. So let's talk about emergency funds first. So an emergency fund is a financial safety net for future mishaps and or unexpected expenses. And it should be about 3 to 6 months of your living expenses. And for those of you who will start a new job soon after residency, this fund is important because it may be a while before you get your first paycheck. And I'm sure Dr. Cochin can also attest to that when we first started. So about half of our group that was polled didn't have an emergency fund. So why do you need one? It creates a financial buffer to keep you afloat in a time of need. You should not have to rely on high interest credit cards or loans in order to pay for something in an emergency. There are a couple ways to build one. One of them is to save tax returns to build up your fund. That's the smart way to do it. A lot of times when we get our tax returns, we get excited and want to spend it on something because we think it's free money. Technically, it's probably a better idea to try to save that money. You are paying those taxes consistently throughout the year. You're just overpaying on the taxes, but it would be smarter to make sure that you have an emergency fund with that rather than trying to spend it. Another thing you could do is also save a small percentage of income monthly until it's sufficient. And like I mentioned before, this would count under your 20% part of your budget under the savings and debt repayment. The other question is, where should you keep it? So I would recommend keeping it in an account where funds are easily accessible or liquidated. So what I'm talking about are high yield savings accounts, money market accounts, even certificates of deposit, although certificates of deposit, you won't have access to the money for at least a certain amount of time, usually around something like 5 years. They do have higher interest rates though than a high yield savings account, but high yield savings account is a lot easier to get money from. Even the banks without brick and mortar locations can get you money within one business day. I also threw in a wild card in here with the Roth IRA, which we'll talk about later. Technically, can also be used as a emergency fund. Not a lot of people know that. So we'll talk about debt first, which is every physician's favorite topic. So here are just a few types of debt that most of us likely have. So we'll talk about credit cards, student loans, car loans, mortgages, and even personal loans. So we'll dive into some of the more common types here. We'll start with credit card debt. Many like to talk about how high their credit limits are on their cards. The problem is that doing that encourages us to spend up to the limit. Do not fall into this trap. This is why many people have numerous cards carrying balances from month to month, and this could potentially drown you in debt because the average interest is 20 to 24%. So imagine if your student loans or any other loans you had were at 20%. And that's kind of the image I want you to have of carrying credit card debt. Therefore, this is one of the ones you should pay off ASAP if you have it. But I don't want to scare you away from credit cards. They're actually extremely useful and beneficial if used properly. By that, I mean that you should pay off your entire balance each month on time. Do not use more than 30% of your total available credit at any time. So I actually just checked mine yesterday, and I'm using about 4 to 5% of my available credit balance, which is kind of where I like to keep things. As I get closer towards 10, it's that gets me worried. So definitely don't go anywhere close to 30. And that actually negatively affects your credit score too, if you want to get into credit, how credit scores are calculated. I don't really have a section for that in here though. You should also keep your cards open when they're not in use, assuming that you don't pay any annual fees. And the reason for that is, again, part of the credit score. The length of your credit history is super important for that. Sometimes people, in my case, one of my credit cards has been open for 24 years. I haven't really been using credit cards for 24 years, of course, but my dad was smart and opened up a credit card in my name as an authorized user. Obviously, I wasn't using it, but it helped build my credit history. And he's kept the card open ever since. So that's something that if you have kids, I would consider possibly putting a credit card in their name, even if they can't use it. But it is something to kind of, it's an easy thing to help little kids out, get them started as far as their credit history and everything. Um, if this only works if there are no fees on it, of course. So I've kept that account open and it just helps my credit score. So going back to the actual debt itself, what if you actually have a large balance? So definitely pay more than the minimum amount, and that will count towards your 20% savings and debt repayment. So again, that would go under that 20% category for your budget. Um, and that's how that fits into where your take home money is going. But remember, I would prioritize this debt for sure, because 20 to 24% on average is a lot. And that's an easy way to get behind the eight ball and continue to make huge interest payments that you can't get ahead of. I don't want any of you to fall into that. So now we'll shift gears from credit cards to student loans. This is our favorite, of course. Many of us haven't made payments on these in a while due to forbearance, especially if you're on the SAVE plan, such as myself. Again, this is also likely your largest balance. As residents, you should apply for an income-driven repayment plan. I know right now it's very difficult. So I know I've given this talk yearly. This is the most different it has been with the loans because of the administration, of course. We're not really sure exactly what's going to happen to SAVE or any of the income-driven repayments. My gut, and I don't know exactly what's going to happen. My gut is that he's going to basically consolidate some of these income-driven repayment plans into something that doesn't subsidize all the interest like the SAVE plan does. So something more in the middle of SAVE and what repay used to be in prior administrations. That's my guess, but time will tell what ends up happening with that. These are good for federal loans, though, of course. I know not all of you will have federal loans, but for those of us who do, try to take advantage of some of these income-driven repayment plans. It can definitely help out in residency as well, but even into your first few years as an attending, it definitely helps. As far as private loans, you should try to refinance them if lower interest rates are possible. So I don't know if any of you get a lot of mail from places like Sally Mae or like a lot of other companies that are trying to refinance your loans. See what they have to offer. It's never a bad idea to kind of look around at different rates that you could possibly get, especially if you want to try to drop it. Right now, I think the average interest rate is still fairly high, so it may not be a great time to do it. But I remember, I think when I first gave this talk right after COVID, it was actually not a bad idea to be refinancing. I would try to avoid deferring payments though. It allows a lot of interest to accrue before starting payments. And then again, like I said before, for the credit cards, you'll end up behind the eight ball. And again, being behind is never great when it comes to these interest payments. So what do you do after residency? And that depends on your future employer. So if you're working for a qualified employer, I would consider pursuing public service loan forgiveness. Again, I say that with a grain of salt. I'm not sure what's going to happen with some of these programs going forward. But usually with public service loan forgiveness, the crux is that after 10 years of qualified payments, the remainder of your loans will be forgiven. Again, not sure if it'll be around, but it's something that if you get on an income-driven repayment plan and just continue making consistent payments, even if they pull the rug out from under you when it comes to public service loan forgiveness, at least you're still making payments. And then you can always increase your payments at that point if they ever tell you that it's no longer a program. So it's still not a terrible idea to still put yourself on an income-driven repayment plan and to move towards public service loan forgiveness. If it's not an option, though, the best thing to do is really just to refinance your loans and pay them off quickly. Quickly is different for everyone, but I wouldn't I probably wouldn't live on ramen noodles in order to pay your loans off, but then I also probably wouldn't, do the opposite on the spectrum and, pay almost nothing for it. So I put a key point here though. If your investments are doing better than your loan interest rate, it's probably better to use your money investing, which means make the minimum payment you can on the student loans, and then prioritize putting your money into the market. Again, market right now, not sure what's happening with it, but at least it's mostly recovered since the administration changed. So car loans, these are straightforward. Don't buy more car than you can afford. And no more than 10% of your monthly take home should go towards your car payment. Dr. Cochin's smiling. Yeah, so for those of you who love cars, such as myself, it may be tempting to buy that expensive car as soon as you become an attending. But I'm here to tell you that you should make sure your finances are in order first and your debt is well managed before doing something like that. But some of you might be saying, but Josh, I've waited so long to be able to buy something that I've always wanted. Haven't I delayed gratification long enough? And that's a great question, but that's also a very slippery slope. Instead, focus on making the right decisions to save, pay down debt, and make that a habit. Once you're in a position with the money in the budget to allocate to something you like, such as a nice car, go for it. This is the beauty of budgeting and financial literacy. There's a balance between living life and being financially responsible. They're not mutually exclusive. So let's talk mortgages. This is considered a good debt because it's long-term, shows financial stability, requires responsible credit use. It can set you up for some tax breaks. It will likely gain value over time, and it allows a return on investment. I was lucky that I purchased my house in 2019 before the market got crazy, so right pre-COVID. And if your goal is to venture into real estate, you'll need to have a lot of experience with these mortgages. So to summarize this section, make a budget now, know where every dollar is going, start an emergency fund, focus on paying down your high interest debt, such as your credit card debt. And then, if your student loan debt is high, focus on that as well. Live like a resident, stick to a budget, use any extra income to pay down what you can, and then that's how you would build net worth. And then establishing these habits now will set you up for early financial independence. So now let's discuss insurance. Remember that your most valuable asset is your ability to work and earn a salary. Disability insurance will pay you in the unfortunate situation where you are not able to work due to a disability. You would receive a predetermined amount if you meet the definition of disabled as outlined in your plan. Most workplaces offer it, but usually it's with limited coverage. Many people think that workplace disability is good enough, but the reality is that these plans often provide less benefit with weaker definitions of disability, meaning it's tougher to actually qualify for the payments. So I encourage you to examine your employer's plan carefully and consider an individual plan if it isn't good enough. And just to note that 1 in 7 doctors end up having to use disability, so that's why this is super important. There are some important terms to know when looking for disability insurance. Own occupation is a type that covers you if you are unable to perform the majority of duties that you are trained to perform. So in other words, if you're unable to work as a physician, even if you can work a different type of job, you will be paid for the job you're unable to do. This makes sense because as physicians, we all spent many years of our lives training for one thing. And if something happens preventing us from working, were those years just a waste? So that's why, again, own occupation is super important to have in your definitions for your disability insurance. A benefit period just notes when payments start and end. So usually they go to age 65 or 67. Partial versus full disability, each plan is different. So make sure to read through this to know if you would be covered for partial disability, or at what point are you considered fully disabled. So again, different per plan. Riders, you'll see this term. These are additional features of a policy that usually cost an additional premium. So inflation protection, that's cost of living adjustment. It's so the amount paid increases by a small percentage every year. So that's important to have. Future purchase option is super important for all residents who are getting this. It allows you to buy more coverage without a repeat exam. So I remember when I became an attending, I just asked my insurance guy to add an additional monthly for a benefit to my plan, and I didn't have to go redo the entire process of applying for disability insurance once again. It was super easy to add that. Non-cancelable and guaranteed renewable, those ones are self-explanatory, but those are also important ones to have in your plan. So I recommend getting disability insurance as soon as possible, ideally before becoming an attending, because it's cheaper. And like I said before, make sure it has the future purchase option. In terms of how much you need, residents will usually buy about $5,000 a month of benefit, while attending should buy at least 10 to 15,000. And so just for an estimate of costs, this usually comes out to about $100 to $150 a month for residents. And then for a benefit of 10,000 per month, I would expect to spend about 300 to 400 a month. So switching gears to life insurance, this is a legally binding contract that pays a death benefit when the insured dies. The money goes to your named beneficiaries, and life insurance is a must if someone else depends on your income. So the main types of life insurance are term and whole. Starting with term, term is simply insurance only. It covers for a term which is usually 20 to 30 years. It's much cheaper than whole insurance. So the average 30-year-old can get a 20-year term policy with a 500,000 death benefit for about $25 a month. So really not too much, even on a resident salary. Whole though is permanent. So that one never expires unless you stop making payments. It does have cash value. So what that means is that there's a certain amount of value that your plan will hold, and you can actually borrow against that money as a loan. And I actually just did this just to try out and see how easy it was to do. And the money came in about one business day, and so it's very, very easy to borrow against your own plan. Cash value grows tax deferred, which is often only 1 to 2% annually. So I wouldn't want you to think of this as a like an investment account. 1 to 2% annually isn't great. And then, of course, at the end, whole life insurance is more expensive than term. So what I'll say about these two is that generally term is the way to go, although whole life can have its benefits. I just don't want you to be misled into thinking that whole life is perfect, because it's also an investment vehicle, as you know, the cash value will grow, like I said. But remember that 1 to 2% annually doesn't match what you could do in other accounts. You can do much better in other accounts. Finally, we'll talk about retirement. And I know you're probably thinking you're still young and why you're thinking about retirement, but you know, everyone should be thinking about retirement and their future financial security. And the earlier you start thinking about it, the better. And we have a lot of accounts to cover in this section. So when I polled the group, more than a quarter of those who responded said that they were not saving for retirement. And it may be tough as residents, but it is crucial to try to set aside something. Then we asked if people were aware of the types of accounts that they held. What these results showed me is that many weren't aware of the options. So first section was 401As, 401Ks, 403Bs. We'll talk about those in depth. We'll also talk about Roth IRAs in depth. I was actually impressed that 31.3% of people who were polled said that they had a Roth IRA, which was great. I was expecting that number to be lower, Traditional IRAs, I'm assuming that a couple of our attendings said yes to that. For the pension in the 457, had to have been an attending, not available as a resident. You don't make enough money for that. And the 22 people, or 34% of the people I polled, said absolutely no idea. And those are the people I'm targeting with this. I want to make sure that you are aware of these options. Retirement plans also depend on when you'd like to retire. So historically, 65 plus has been the most common response, but there are certain groups who target much earlier ages. So even a small sliver of the ones that we polled said before 50. So that requires a much different mindset when it comes to saving and budgeting, which we'll talk about very, very briefly. So why start now? The answer is compound interest. The most important thing about saving for retirement or investing long term is time in the market, not timing the market. And that's very important to make that distinction. I like to say that the best day to start saving for retirement was yesterday, but that's not to make you feel bad. It's just to emphasize that the longer you wait, the less you can make. How much should you be saving? So as a general target, you should aim to save 10 times your salary by age 67. So keep in mind that the earlier you start saving, the lower your savings rate needs to be. If you started at 25, you only need 15%. But look at the difference if you started at 35, you'd need to save 23% yearly, which is obviously a significant difference. So this is part of the reason why it's difficult as residents, is because we don't get our first real jobs until we're in our late 20s, early 30s. And so versus our peers who started their careers right after college, we're again behind when it comes to starting saving. And of course, that means that we're going to have to compensate by saving more or a higher percentage a year. So I wanted to introduce the concept of FIRE. Not sure if any of you are interested in this, but it stands for Financial Independence, Retire Early, or at least a lot earlier than the man with the cane in that photo there. It is a movement of extreme savings and investment that aims to allow someone to retire far earlier than normal, which is often as early as 40. Savings rates are through the roof, though, and they can be up to 70% of your annual income. So just imagine saving 70% of your annual income and living on only 30% of your salaries. Definitely not possible as a resident. I can guarantee you no one's going for FIRE as a resident. But when you become an attending, you can make this choice if you really want to. So what happens is that you'll live off of small withdrawals from the funds that you've saved. And so I'm not suggesting that people do this. I know that I certainly don't plan on it, but it may be something that interests you if you really do not want to keep working. Why should you use these retirement accounts? So that's the question. The answer is taxes, though. Retirement accounts have tax benefits. So your salary is taxed before you receive an amount, and so what you receive is post-tax in your hand. If you invest that money, you'll have to pay taxes when you withdraw, and you can think about it as being taxed twice, or you have to pay taxes on the gains, like capital gains taxes. It's something that's considered tax drag if you're using normal accounts. So for example, you have your gross salary, and then taxes, benefits, payroll reductions are all removed. This leaves you with the take-home amount, which you can invest and save. But then those gains are taxed and removed. Like I said before, it's known as tax drag. And what you are left is with a nest egg that is less than what it could be if you can somehow avoid taxes at one of these steps. And I'm not going to get into the nitty-gritty of like tax loss harvesting. If you guys have any questions on that, that's a different conversation, but it's something else to look into. Those are more advanced techniques, I would say, but I just want to get the basics in here. And so we don't want you to feel like this man, so that's why I would recommend using tax benefit accounts. So there are two main categories. So tax deferred accounts on the left side there take pre-tax dollars. What that means is that it comes right out of your gross salary. And so you are not taxed on this money at all. And so actually what happens is that it actually technically lowers your taxable income. So, for example, if you were making 250,000, and you were saving 20,000 into a tax deferred account, what would happen is that your taxes would be calculated on just 230,000 rather than the full 250. So, and then that 20,000 from that was taken aside will just go directly into a retirement account. So when you withdraw those types of funds, though, the amount is taxed as income. So you have to pay taxes on what you gained. And examples of this are traditional IRA, a 401k, and a 403b. So when you hear those terms, those are generally tax deferred accounts. There are some exceptions, and there are some accounts that can do both, but for the most part, those ones are, purely tax deferred. On the other hand, tax exempt accounts take after tax dollars. So after you have your gross salary, you paid your taxes on all of it, and then you use your take home to contribute. So technically, it didn't lower the taxes you paid. However, when you withdraw from those accounts, since you've already paid taxes on them, you don't pay any taxes on the gains, you don't pay any taxes on the withdrawals. So an example of that would be a Roth IRA or a Roth 401k or 403b. So to transition to this slide, a traditional IRA is exactly what I was referring to with the tax deferred account on the last slide. Contributions can be deducted from taxes at filing, but the thing is, for traditional IRAs, physicians generally make too much to qualify for these deductions. Withdrawals then are taxed as income when it comes to the traditional IRA, because again, it's a tax deferred account. It's not generally recommended for physicians. So, going back to that poll, there were a few people who had a traditional IRA, and I was assuming that they were attendings because there's only one instance in which I would recommend a traditional IRA, and I will discuss that in a later slide. On the other hand, a Roth IRA is a tax exempt account, just like I showed you on the previous slide. So after tax dollars go in, and then the withdrawals are tax free. So let's start talking more in depth about a Roth IRA and why it's a super important one for I know most of you are residents here, or new attendings. Either way, Roth IRAs are super important. So, like I've said, a Roth IRA is an individual account that takes after-tax money, which you can invest how you wish, and you can remove tax-free once you reach 59 and a half. It is best for those whose marginal taxes will be higher in retirement than they are now. So just imagine for yourselves, as residents, your marginal taxes will 100% be higher when you retire than it is right now. Because you are guaranteed to make more later on than you are making now. So paying taxes now on a low resident salary makes sense when the money can then grow without needing to be taxed again. So this is in contrast to saving on taxes now, but having to pay taxes on the money when your salary is much higher later on. So if you recall, though, I did list the Roth IRA as a potential place to keep an emergency fund. So I'll explain that. The reason for this is that you can actually pull your contributions from your Roth, but not the gains. So you can only pull the contributions without penalty. And so if you're starting a Roth IRA and you're worried that if you throw it in there, you can't touch it until 59 and a half, it's not quite true. If you still need your money in a pinch, you can take only what you put in, but you can take that amount out and you don't have to pay a penalty for it, and you don't have to pay taxes on that money as it comes out as a penalty. So technically a Roth IRA can be used as an emergency fund. Just keep in mind that this process will probably take a few business days. So it's not the quickest of emergency funds, but I always try to tell my residents this when I'm trying to convince them to start a Roth IRA, because they're worried that if they put money in there and they happen to need it before 59 and a half, they're never going to be able to see it again. So it's not quite true. So limits to a Roth. It's not perfect. Income must be less than 150,000 for single filers, 236,000 for married filing jointly. The contribution limit is 7,000 a year, but if you are 50 or older, the limit is 8,000. And that's what's considered a catch-up contribution. So what if you're an attending and you make more than the limit? So a backdoor Roth IRA would be an option for you. I know this slide might be tough to see, but it really is a step-by-step guide to performing a backdoor Roth. It sounds illegal, but it's not, at least for now. This is the only time, like I was saying before, that you should open up a traditional IRA as a physician. Because the way that it works is that you contribute to the traditional IRA and then you transfer or convert the money into a Roth. And it works because you've already paid the taxes on the money that you are using to put into the traditional IRA. And when you convert to Roth, no taxes are due in that transaction. And so Roth only takes after-tax money. So since you've already paid those taxes, you're fine. So then your money will be taxed, and then, or I mean, you've already paid the taxes on the money, and then it will then be in a Roth account, and then it can grow tax-free. So that's basically what a backdoor Roth is. It's a pretty straightforward process, and there are a lot of resources depending on what companies have your accounts. So like mine are in Fidelity, so there's a step-by-step process as far as how to do it through Fidelity. But if you have Vanguard or Charles Schwab or any of the other TIAA, whatever you got, there's a way to do a backdoor Roth. So here's an example Roth. I put my own values into a calculator a few years ago when I had about 24 grand in my Roth. And it was calculated that by age 67, I should have about 1.08 million of tax-free money. And that was with an average return rate of 6%. I purposely made that on the lower side. I mean, usually if you're investing your Roth fairly well, you can expect 8 to 10% on your average return per year. Which drastically increases that number, which already sounds good at 1.08 million. Imagine having that much just as tax-free money to spend and do things with, go on a nice trip or whatever. But yes, that number could be much higher depending on how you invest it. Therefore, you should start a Roth as soon as possible to take advantage of the compound interest. So it's time in the market, not timing the market, like I said before. Take advantage of the market right now by throwing in money. Actually, when the market's down, that's the best time to be throwing money in. So I will take a quick break from retirement accounts and give you all a brief introduction to investing. So when you invest money in your IRA, you can choose any fund. A stock is a security that represents the ownership of a fraction of a company. So take Tesla, for example. If you buy a share of Tesla, you own something that represents a fraction of the company. So when Tesla does well, your holding will gain in value and vice versa. A mutual fund is a financial vehicle that pools assets from shareholders to invest in securities such as stocks, bonds, etc. It is professionally managed, and this means it costs extra to hold or own, but it gives investors access to diversified portfolios because by buying a fund, you actually own a small fraction of multiple companies. So you probably heard of the S&P 500. If you buy a fund like that, you would own fractions of one share of 500 of the leading traded companies in the US. Specifically, buying the S&P 500 would likely mean buying an index fund, which is a very specific type of mutual fund that is passively managed and is cheaper to own. So an ETF is a mutual fund that is a pooled basket of stocks or bonds, and it can be traded during the day. So that's the main difference with mutual funds and ETFs. ETFs can be traded during the day. Bonds are fixed income instruments that represent a loan made by an investor to a borrower, which is typically corporate or governmental. So getting into a little bit of portfolio. So index funds are a portfolio of stocks designed to mimic the composition and performance of a financial market index, such as Dow Jones, S&P 500, or NASDAQ. If any of you have worked with me and seen me check my Apple Watch during the day, it wasn't because I was checking the time. I was probably tracking the S&P 500 for the day. The advantage to these funds is that they have lower expenses and fees due to being passively managed funds. And so they seek to match the risk and return of the market, which is based on the theory that in the long term, the market will outperform any single investment. So as you can probably tell, this is a long-term investing strategy that is lower in terms of risk, which is why it's appealing for retirement accounts. It may not be as interesting as meme stocks such as GME when that was a thing, but with a return of almost 10% on average yearly over the last 30 years, you can't ignore index fund investing. So that's something to definitely look into. So now we'll shift from individual retirement accounts to 401ks or 403bs. These are employer-sponsored retirement plans. So you, the employee, will contribute a certain amount of your salary in what is called a salary deferral, which is, again, usually pre-tax, and your employer can match these contributions. So these are invested, they grow over time, and they can be withdrawn when you are retirement age. So the advantages are that these are tax deferred accounts, pre-tax, like I said. This lowers your taxable income, like I gave in the example before. And if your employer matches, you have to take advantage of this free money, which is, as you can see in that diagram there. So when I was working at Upstate, they gave 8% of your state salary and only required a contribution of 3.5 to 4.5%. So it was actually more than just a match. They gave almost double. And so my current employer does a 4% match, which is still, again, 4% of your salary that is handed to you just for being responsible and saving for retirement. So again, free money. So the limits for 401k, 403b contributions are much higher than your IRAs, which was only like 7,000, right? So 23,500 if you're younger than 50, and it's 31,000 after. So that again is a catch-up contribution. Unlike an IRA, though, you can't choose any fund. Your employer gives you a list of funds that you can choose from. So my advice is to choose low-cost index funds if they are offered, as these also give good diversification. When you're looking at your portfolio, though, your stock to bond ratio is super important. And what that means is that the percentage of your holdings is stocks, and then there's going to be a percentage that is bonds. So bonds are generally considered stable income or funds. And so you should own a higher percentage of those when you're closer to retirement, since you don't want to risk a large proportion of your nest egg to market volatility. The final option I have on here is a target date fund, which does everything as far as shifting from being more aggressive with more stocks as you're younger, automatically as you get closer to your retirement date, changes to a higher percentage of bonds. So all you have to do is pick a fund around the year you'd like to retire, and then the fund automatically adjusts the ratio. I recommend those frequently to those who would rather set their account and then forget about it. So the number of times I've had residents throw their money into a target date fund and then, just set up automatic investments, and that's it. So when you withdraw your money after 59 and a half, it is taxed as income. There's a 10% penalty when you try to withdraw before that. Also, there are required minimum distributions that start at age 72. But those are mandatory withdrawals once you reach that age. So you can't just keep the money there and not take anything out of it. So a little more advanced info here for the attendings. Your contributions should be maxed. Remember, if you think back to the slide on target savings rate, so 18 to 20% of a 200K salary is more than 23,500. So if you find that you're not able to max out your 401k, 403b contributions, you should probably take a closer look at your budget and cut down where it's possible. But there are small details that many miss out about their accounts. So many employers offer an option to make some of the contributions after tax, and so that's what's called a mega backdoor Roth. I know some of these names are interesting, but it's separate from your Roth IRA, but the money functions similarly with a higher 23.5K contribution limit to note. The only difference is that you are limited to the investment options in your employer's plan. So again, you can only choose funds that they give you. If you elect to make all of your contributions Roth, you can have a large nest egg of tax-free dollars in the future. Because imagine having a Roth on the side, Roth IRA, and then mega backdoor Roth, you can have a lot of after tax money later on. This is also for the attendings. So 457 plan is much like a 401k, 403b in that it is an employer-sponsored tax benefit retirement account. Employers that offer it allow an additional 23,500 or 31,000 to be contributed to retirement with same benefits as a 401k and 403b. And then most often these are also tax deferred accounts. So we've reached the end. I know that was a lot of information and I was checking the time. I went, I guess, 50 minutes. But I hope that was mostly helpful, and I'm sure some of you may have some questions about that. We'll make sure that this is available to all of you, to refer to going forward. But to summarize, make a budget and stick to it. Pay down your debt, especially focusing on your high interest debt first. Consider buying disability, definitely that, and then life insurance if you have dependents before the end of residency, and then save for retirement using a Roth IRA and your employer-sponsored 401k or 403b. So some references and resources that I use. Investopedia is great if you have any questions on any financial terms or anything like that. And of course, IRS's site actually has a lot of information on taxes and everything if you're actually interested in a read. So when I initially gave this presentation, of course, I had a few mentors, Dr. Gambier being here, being one of them, and Dr. Kuhn, Dr. Connor, two of my current colleagues here. And thank you to NYCP for allowing me to give this talk again, and hopefully it was helpful. So,
Yes.
any questions?
So there's some great comments in the chat. There is a question in the chat. Can you only contribute the 7K max even with the backdoor Roth?
Yes, even with a backdoor Roth, it's still 7,000, unfortunately, because it still falls under your IRA contribution limits. So I know on Fidelity, when you use the app and everything, so as I've been contributing to my backdoor, it says per year. So like for 2025, I've contributed this much. For 2024, I've contributed this much, because technically you can still contribute for the prior year. So for up until taxes are due. So about April 15th is when they'll cut off. So April 15th, 2025, up to that point, you were still able to contribute for 2024. The thing is, I wouldn't recommend doing that though, because that gets very complicated with all the paperwork required to say like, oh, this contribution, although was given in 2025, was for 2024. When you're filing your taxes, it does make it a little bit more difficult because there are a lot of other forms that need to be put in there. So my recommendation for that is when you are doing a backdoor Roth, try maxing out your contributions, one at one time, and two within the same year as the tax year that you're contributing for, as much as possible. Makes things so much easier.
I have another question. Does the backdoor Roth have any risk when applying the process versus just doing a traditional IRA, assuming that you would earn more than the cutoff for the traditional, for the regular Roth?
Any risks when applying the process versus just doing traditional IRA? I mean, assuming you make more than the bracket, there's no benefit to doing a traditional IRA at all. So what happens generally with a traditional IRA is that if you make less than the bracket, when you file your taxes, you can say like, hey, I contributed to a traditional IRA, but you're contributing after tax dollars because it's an individual retirement account. So you did it on your own. So it's with your after tax dollars. So basically then when you file your taxes at tax time, you can get some of that money back if you make less than the contribution limit. So there's really no point in just doing a traditional IRA. If you make more than the bracket and you're contributing to a traditional IRA, you kind of have to just switch it over to a Roth. Otherwise, it just doesn't make sense that you did it. Really no benefit. Yeah, the comment on the 457 is very true here. Yeah, it can be risky for small private employers because funds are not owned by the employee. Yes, government 457s are very secure by comparison. That is a very good point.
For those who don't know, do you want to tell us what a 457 is?
Oh yeah, so I had a very quick slide on that. It was
Okay.
just it's an additional account on top of 401k, 403b type employer sponsored plans. But that is very true. So depending on your actual employer, small private employers, that if you read the fine print, those funds aren't owned by the employee. So they can be risky depending on how your private employer actually does. But if you're in a government 457, those are obviously much more secure. So just something to look into when it comes to that. 457 is the last thing that I would think about anyway, even as an attending. I actually don't have a 457 option even, but for maxing to 403b or 401k is probably where people should start. Let me see what else is in here. Yeah, so pregnant women applying for disability insurance is very, very tough. Yes. For sure. Yeah, and you should apply early. Yeah, very good. Yeah, good comments in there too. I tried getting all my interns. So I tried giving this talk to interns actually most of the time. So at Upstate, they still have me giving it once a year to mostly the intern class. And I try to convince all of them that they shouldn't even wait until second year to get disability insurance, just because you never know what's going to happen. I've had some residents who come and see me refuse to come and see me because they didn't want me to diagnose them with anything while they were applying for disability, even though I wanted them to come into the office. Any good recommendations for high yield savings accounts? I mean, you can look to see which rates are the highest. Right now, on average, the rates are like 3.5% to 4%. So I mean, you don't need a brick and mortar bank for these type of things. So I remember when I got mine a few years ago, Ally and Discover were two of like the highest earning ones, but were also a couple of the most reliable. You just have to make sure that they're FDIC backed and everything. Usually, 250,000 type of, it's pretty standard deal with that. And those accounts, even though they don't have any brick and mortar locations, are very easy to use through like mobile or just to access and online. So Ally and Discover, I always recommend, but then I usually look to see, like, if you just search high yield savings accounts and their current rates, you can see who has higher rates and then kind of how, see how they're doing as far as how easy it is to access them. And then if you paid your debt, should you start with an emergency fund, then invest, or invest aggressively before acquiring an emergency fund? So I wouldn't invest aggressively before acquiring an emergency fund because you never know when you're going to need an emergency fund, right? So I mean, like right now, my Ring camera keeps going off because people are doing my roof right now. It was unexpected expense, so you always want to have some money saved up, just in case. It doesn't have to be like losing job related, but even a roof is not a fun thing to just randomly have to pay for. It's not something I budgeted for, right? So I would always make sure you have some kind of an emergency fund before starting to invest. Paying debt off, of course, usually it depends on how high interest it is. If it's a credit card, that is technically an emergency. So if it's high credit card debt, I mean, you're paying 20 to 24% on that. That's way higher than any emergency fund can earn just with a high yield savings account. So I would pay that kind of debt off first. Student loans kind of fall in the in between gray area. So that one, I would still make sure you have a little emergency fund, but then I would definitely prioritize the student loans.
And I'm just gonna say, for the sake of time, there's one
Mhm.
last question. Maybe we can get to that. And I was gonna mention, I'm sure everyone can see, but you put your email in there. Um,
Mhm.
I'm I know that you love talking about this. So if there's any other questions, I would definitely recommend sending Josh an email. Um, that way, if there's any other questions, you can get another opinion about it as well.
Yeah, so as far as the last question here, so where do you fall on the rent versus buy debate? That really depends on where you live. And actually the time you're in. So right now, rent versus buy debate. Generally, I remember when I was doing it, it was did I plan on spending my time there for at least 3 to 4 years was really where that cutoff was. If I thought I was going to stay in that location for 3 to 4 years, it was probably better to buy than it was to rent. But then again, that also depended on the actual cost of the property itself. So and what you're doing with it afterward. So my plan was to rent my place after, so I would keep it and then rent it out. But you don't know like how tough it is to find tenants. There's a lot of stuff when you decide to be a landlord too. So the buy versus rent debate, I would probably just take a look into the current market in whatever area you're going to, and then compare rent prices to how much a mortgage would be if you decided to buy something. But again, the market may dictate where you fall on that because it's really, really, really hard to find a place right now. It's very much a seller's market. And then, yeah, at what point do you think you'd swap over to one or the other? Again, yeah, it depends on how long you're thinking about staying. Okay, did I
Awesome.
talk
Thank
enough?
you so much for
Yeah.
going over. I know it's a lot of information, but it was definitely really, really helpful. And it has really good starting points, which I think is really, really great to know for those who don't.
Right. And those were good questions after. And that's kind of
Yeah.
the goal of this is to kind of give the framework and then get you guys thinking about the questions you want to be asking.
Awesome. Well, I thank everyone for joining us and have a great evening.